Hi, and welcome back to Accounting 482. This is session 32, and we finished module 3, and now we're into module 4, and this is where we start making decisions. And I need to make this into a real slideshow. Probably I've already seen information that I didn't want you to see. Okay, so this session is going to start out a little bit different. I have 5 different scenarios for you, and I want you to take a look at them. And I'll just let you see them and read them, and I'll give you time later to work on them, and we'll decide if these scenarios is a something that we should do or something we shouldn't do. So this first one here, this dentist is thinking about outsourcing their denture making. And should they start buying their dentures from somebody else? And the answer is no, and we will show you how to do that. And in the second scenario, Tremaine is considering dropping product line A, and they are losing money, but should they drop product line A? No, and we will show you how to do that. And in this one, number 3, Big Al's is considering the purchasing a new equipment costing $15,000. Assuming that Big Al's normally makes 8% on its investment, should they buy the new machine? No, it's not that expensive and they're making some money, but no, and we'll show you how to do that. And then O'Malley has purchased an asset for $90,000. Annual operating inflows are expected to be $20,000. No salvage value is expected at the end of the asset's life. Assuming O'Malley's cost of capital is 16%, which is really high, but if you have bad credit, you might have that. What is the asset's net present value, ignoring income taxes? And the net present value is actually negative $16,000, and we'll show you how to do that. And then the last one here, Morris manufactures 2 products, and widgets and gizmos. And so how many gizmos should Morris make each month to maximize their profits? And we talked about maximizing our profits in the very beginning of the lectures, and they need to make 1,000 gizmos, and we'll show you how to do that. So I want to show you what we just finished, and then I want to show you where we've come and where we're going, because we're winding the class down, believe it or not, and I want to show you what we've got going on. My dog is digging on her bed again. I don't know why she does that. She makes it fluffy. Okay, so we just finished profitability analysis and risk analysis and in session 3. Now, this is where we're at. We have tracked our costs. We have done our budgeting. And we have analyzed our performance. And now, you need to make your decision, right? Yes, you do. You have all this information in front of you. You've done all this research, you have all these tools. But can you make your decision? No, not yet, because there's different criteria and different methods to make a tactical decision or a capital investment decision. And you need to take a look at these 2 different types before you can narrow it down, and then from there you have more tools to decide if you will do this, make your decision yes or no, or your capital investment decision yes or no. So tactical decision making can be broken down into, first you need relevant information. And we talked about the relevant range, and the relevant range is a range where fixed costs are relatively the same. You have fixed costs and that are the same in a relevant range. Now, this is relevant information, which means the information that you have is pertinent to the decision. And we're going to take a look at relevant information. Nope, get down, babe. And the examples are special orders, outsourcing, keep or drop decisions, and sales mix. And then we have capital investment decisions, which we'll discuss in our next video for this lecture for this week. So making business decisions, and these are Jason's slides again, and he's got some really cool animations going on. So we're just going to go ahead and go with that. And once I switch over to my notes, then we'll take that off. So the business decisions fall into two main categories: short-term tactical decisions and long-term capital decisions. And that's why the decisions are different for each one. Your tactical decisions have immediate effects, a short span, and no time value effects. A tactical decision is, should we hire more people, more manufacturer workers? Should we hire, should we make should we start making this new product? And that is a decision. Should we cut costs? These are decisions that can take effect immediately, and there's no time value effect. There's no big investing or anything like that going on with those. And capital investment decisions have long-term effects. It takes longer to build a new plant so that you can make more widgets or gizmos. There's longer time to implement those plans, and you have a large cash need. And so you have cash, you have financing, stocks and bonds come into that, and then you have significant time value effects. A lot of times you have 3 or 4 different decisions to make. You want to go with one of the 4 options, and you will take a look at time value money. You look at net present value of each decision to see which one is best. The one you think that would be best sometimes isn't. So your relevant information has bearing on the future, and this includes fixed costs. Do you need fixed costs, or can you eliminate fixed costs? They differ among competing alternatives. So if you have some costs that can be eliminated in one option, but different ones can be eliminated in another option, they differ. They're different. So this is relevant information. And only relevant information should be included when making a decision. Again, sunk costs are not relevant because you can't do anything about those. Those are done, they're sunk, and you can't get that money back. And remember that we all look at the sunk costs, and we shouldn't. Now, we have relevant or irrelevant. Example number 1, Massel has been offered a new machine by a vendor. Listed below are all of the costs associated with keeping the current machine and buying a new machine, because this is a decision that managers make all the time. What costs are relevant to the decision? Which machine should Massel choose? So we got information flying in. So our new machine, the list price is $30,000. The annual operating expenses are $45,000, and the expected life in years is 1 year. And you think, wow, that's a lot of money to spend on something that's 1 year. But in business, it may not be. It might be a tool that your employees use that only has 1 year life, and you have to have it. So, and now looking at the old machine, the old one cost $100,000, and the remaining book value is 25 grand. Disposal value now is 5,000. The annual operating expenses is $80,000, which is a lot, and the remaining life in years is 1 year. So at the end of 1 year, you will have to do something else. So should you buy the new machine now or keep the old machine? So let's take a look. I have to get out of here and get back into my Word document. So keep that information handy for in your mind or on your split screen. However, I wish I could do a split screen. I'm afraid to do it because I'm afraid that you won't be able to see everything. So I just do it this way. I've thought about doing a split screen, but I just don't know if that will be the best thing to do. So the purchase of each one, oh, I gotta move that. And let me double check. Am I making a silent movie? No silent movie. Good. Silent movies don't do us any good. Okay, so the purchase of each machine. So the new machine is $30,000, and it is an expense. So I'm going to put the cost in parentheses because that's an outflow. Now the old machine, it's $100,000. Okay, and we are already paid for that. Now the write-off. So the write-off would be depreciation. And I'll just go like that. Depreciation. And we'll just abbreviate it that. So on the new machine, it will be $25,000, right? $25,000. Because, let's go back to the PowerPoint. The remaining book value is $25,000. So that's the write-off. That's the depreciation on that. And the old machine again is $25,000 as well. And to sell the old machine, we will get $5,000 for that one. And if we keep the old machine, we're not going to sell it. So there's a zero there. And then the operating costs. For the new machine, it's $45,000 per year, and the old machine is $80,000, which is quite a bit. Okay, so now we want to take a look at the costs that are relevant. Now the old machine here, this is a sunk cost. We cannot take that into consideration because it's already spent. We've already spent it, and it bears no relevance on this decision. Now the write-off is the same for each one, so it's not going to do anything for us, so we can just eliminate that. It's the same for each decision, so it doesn't help us. And I will put a line through this one as well, just so that we know. And now we have our total cost for these. So if you add up all of these, you're going to get an outflow cost of $70,000 for the new machine and an outflow cost of $80,000. Let's underline this so we know what we're doing. Okay. And so the purchasing the new machine is a better decision because it will only cost you out of pocket $70,000, where the old machine will cost you $80,000. Okay, and so that's how you line it all up like this. You eliminate all of your information that is irrelevant and just look at your relevant information to get your your cost for the two decisions. Okay. So special orders. Now that's a new, that's a little bit different. You want to look at the fixed costs. Are the fixed costs relevant? Well, maybe. Because if the company has excess capacity, then fixed costs aren't irrelevant because they're spending that money anyway. So if they have, instead of their people, their employees not having a lot to do or not, I have found, and I work this way too, and I think most people do. If you have 4 hours of your time to complete the job, you will probably use most of that 4 hours, right? But if you have to get that done in 2 hours because you have work beyond that, sometimes you can do that work in 2 hours. That takes you 4 hours. So, and it's just human nature. It's nothing wrong with employees. That's just how it is. So if you have excess capacity, you're paying those fixed costs anyway. So it those costs are not relevant. Now, if the company has no excess capacity, if you have order after order after order after order, and your poor people are working, one after the other, and there's no breaks in between, then fixed costs are relevant because you have to stop doing one project to take on another. So those fixed costs are relevant. Now there's steps to special order decisions. First, you need to determine if you have excess capacity, and you will know that based on your orders. And sometimes you have certain periods where you're really busy, and certain periods where you're not very busy. So if you take a look at, say, print shops, they are very busy. Or okay, when I worked at Costco, the the bakery just dreaded going into graduation season. And the Costco down in Clarkston had the Clarkston High School, the Lewiston High School. Then they also had the U of I graduation. They had the LCLC graduation. They had WSU graduation, and then they had the two high schools in Moscow and in Pullman. So they had all these graduations in a short amount of time, and everybody ordering cakes. So they knew that they were going to be swamped at that time. But if you wanted to order a cake, say in July, when they had, the middle of July, when the 4th of July is over and everything is fine, then they said, oh yeah, we could do a really fancy cake at that point because they didn't have all of those special orders coming in. Okay, so you want to determine if you have excess capacity, and then you want to calculate total revenue at the special order price, and that'll give you how much revenue you're going to have. Calculate the total variable cost for the special order, and then you calculate the total contribution margin for the special order. Subtract any fixed costs for the order, if there are any. Sometimes you need to bring on more people or get a new machine, get an extra a machine. So at those busy times, I think Costco had 2 wrapping machines where the plastic wrap would come and wrap the cakes, and they would always have to bring out a second one for that particular time because it was that busy. So that would be one thing that you would want to look at. If you don't have excess capacity, you would have to subtract the applied fixed costs because those are relevant. And then if the result is less than 0, reject the special order. But if the result is greater than 0, you accept the special order, because if you have excess capacity, or if you don't have excess capacity, so if you don't have excess capacity, you want to take the special order that gives you the most money, right? So we have a special order decision here, example 2. So Handle Company, pretty innovative. That's again Dr. Porter's. Handle Company has received a special order to make 100,000 copper pots for local store for $29 a pot, plus $50,000 bonus. in order to complete the order in time, Handle would need to rent an additional oven for $100,000. Like I said, hey, they need that extra oven so that they could make all these pots. And using the normal production information below, decide whether Handle should accept the special order if, one, they have excess capacity, and if they do not have excess capacity. So the revenue is $50 per pot that they will get. The expenses, the variable expenses, are $25. Allocated fixed expenses are $15. So we need to get the total expenses to get our profit. And let's go into using this information and the steps. Let's get some steps here. Go back, go back. It's not going to let me. And these steps, so the steps and this information so that we can do our example here. And I will just bring this down. I think I can get it on this page. Yeah, I should be able to. Oh, I should do example 1 so that you can follow it better. And example 2. And I'll move this up. Okay. Example 2. And this is Handle. Handle. So step 1 is do we have excess capacity? And for this one, the first one, we're going to assume yes. Assume yes. Oh, that is kind of cool, but we'll go with that. Okay, step 2. The total revenue that we need, right? And we get that by, let's just go like that, the number of units multiplied by the $29, right? By the $29, I can't find it, $29 plus the bonus, which was $50,000. And this is going to give us and that will give us, oops, no. So this is our total revenue right here. And then step 3, I'll move that up for you. Step 3 is total variable costs. And the total variable costs were, whoops, $25 per pot. Okay, per unit, $25 per unit. And it is multiplied by the 100,000 units. And that gives us 2,500,000. And that is a cost, so we will have it in parentheses, an outflow. And now our step 4 is our total contribution margin. So it is the 2.95 million minus the 2.5 million. And that is going to give us $450,000. And I'll just go ahead and, I like my dollar signs when there's a dollar. And now step 5. Step 5, we're just going to subtract the special fixed cost. And that was that $100,000 for our oven. So let's get that. Oh, I'm going to have to bump down to the next page. So our total with excess capacity I'm going to bold that, is $350,000. So now I'm going to bump this down just because I know it's going to bump right in the middle. Okay, step 6, consider it no capacity is what we're going to go with, no capacity. We need to include the fixed costs because now they are relevant. Okay, and that will be $15 multiplied by the 100,000 that we're going to make. I'm going to drop this down so I don't get over here too far. And that is going to be an outflow of 1.5 million or 1,500,000. And now when you subtract the $350,000, you are going to get a cash outflow with no capacity of $1,150,000. So the decision here, if you have excess capacity, yes, accept the special order. Order. That's funny. Order. And if you don't have excess capacity, do not accept the special order. And these are decisions that you will make. I'm going to save that so I don't lose it. This will be decisions that you will make all the time as a manager, and especially if you own your own business. You're going to be looking at this all the time. Okay, now outsourcing. Now outsourcing is when you have somebody else make your items, like the dentures. The dentist made them in-house. He was looking at doing them outside. So which fixed costs are relevant? Costs that can be eliminated are relevant since they differ between alternatives, right? If you make them in-house, these fixed costs are relevant because you have to pay them. If you don't make them in-house, then you can eliminate them. So costs that cannot be eliminated are irrelevant since they will have to be paid whether you make the product internally or externally. So there are steps to outsourcing decisions. Identify the cost per unit of buying the good or service. Calculate the variable cost for production. Calculate the fixed costs assigned to each unit that can be eliminated by buying the good or service. Add step 2 and step 3 to get the total costs eliminated. We're looking at cost not to make them, but that can be eliminated. And then you compare step 1 and step 4. If step 1 is less than step 4, buy the product. So, Worldwide Airlines has received an offer from Sweet Dough Bakery to supply their in-flight desserts for 41 cents a dessert. Using this internal cost information below, should the company accept the offer or keep making the desserts themselves? So we have variable cost per unit, and the total variable costs are 23 cents, and the fixed costs per dessert are 38 cents. Now, at first glance, you think, wow, they're going to, charge us 41 cents for each dessert. Sounds like a pretty good deal. Well, let's take a look and break it down. And this is example 3. and Sweet Dough. I think it was Sweet Dough Bakery. Okay, so step one. Here we go. The steps. Stop one. No, step. Step one. And that was 41 cents, right? 41 cents is the unit to buy it. Having trouble typing 41 cents, right? Step one, PowerPoint. Where's our, there we go. Identify the cost per unit of buying the good. We have that, 41 cents. Now, what is the cost? This is buying the unit. And if we add up the cost to make, so we'll just put that up here so we have it. And that is 0.23 plus 0.38, right? And that is 0.61. Okay, so we just want to have that up there to compare. Okay. I guess we should have a 1 in there. Step 2. And that is the variable cost per unit. So our variable cost per unit is 23 cents. We have that right here. Okay. Okay. And now our step 3. We want to look at, let's go back here, calculate the fixed cost assigned to each unit that can be eliminated by buying the good or service. And this one is a little bit different. Oh, there goes my voice. Unit, I better make that bigger so it's that can be eliminated. We have that, and let's take a look at all those. We'll go back over here. The bakery supervisor, yes, if we're not baking these, the bakery supervisor, he has to get a new job. Department or depreciation on department machinery, that can go too. The general department or the general depreciation, no, because the depreciation on the factory, they have other departments in there, so no, you can't eliminate that. Indirect advertising, no. They're going to have indirect advertising for other departments, so no, can't eliminate that. And then rent for the bakery, absolutely. You don't have to have that section. We can rent it to somebody else or put in a different department in there. We can eliminate that. Upper management salaries, no. No. So let's go back, and so we can eliminate the bakery supervisor, we said. And he was 4 cents per each one. I know. You think they really have it down this to the 4 cents? Yes, they do. When you're looking at that, depreciation on the bakery machines, and that was, oh, I guess I did not have this at a tab. We definitely want to add a tab. Wow. There we go. 7 cents there. And then the rent on the bakery. And that is 3 cents. So now the total on these fixed costs that can be eliminated. No line. Total cost that can be eliminated is 14 cents. Okay, let's pull up there and go to step 4. Step 4, total costs eliminated. This is total fixed costs. Total costs eliminated are 23 cents plus our 14 cents is only 37 cents. So, step 5, let's go back to the PowerPoint. Step 5 is to compare step 1 and step 4. If step 1 is less than step 4, buy the product. So, step 5. Step 4, if it's less than step 1, buy the product. Step 4 is 37 cents. Step 1 is 41 cents. So no. We can't eliminate enough costs to make it worth buying them. Well, without worth outsourcing. We'll just call it outsourcing. Okay. Pretty good. Pretty good. Okay. So now we want to go back to the very first quiz that we talked about. So Avret and Avret, a local dental practice, currently makes its own dentures for customers. The dental practice has one part-time employee who comes in weekly to make dentures. The employee is paid $150 per denture set. The direct materials and variable overcost per set of dentures is $75 and $25 respectively. In addition, the practice allocates $10,000 of fixed overhead to the denture making department. The practice makes 1,000 sets of dentures per year. An outside company who specializes in the making of dentures has offered to make each set of dentures for Avret and Avret for $255 per set, should they start buying their dentures. Okay, so let's go back to this, and I'm just going to go down to the next page. We're going to say this is the quiz 1, and they're all quiz 1. So this is going to be dentures. Okay. So let's take a look at step 1. And the cost was $255. That's what they want to charge us. So step 2 is direct materials. This is actually our variable cost, right? And I'll do it this way. Direct materials were $75. Direct labor was $150. Whoa. And let's pull that up so you can see it. And variable overhead. Oops, we have to tab that over. Variable overhead gives us $25. So our total variable overhead that line. I wish it would just stop. Okay. Total variable overhead is $250. Okay. So it's getting pretty close, right? Okay, so now step 3 is looking at the fixed costs that can be eliminated. We can eliminate. So our fixed costs, going back to the slides, in addition, the practice allocates $10,000 of fixed overhead to the denture making department. And $10,000 divided by 1,000 dentures that they make a year comes out to $10 a unit. Now, The key word here is allocated. So they have these costs, but that's where they allocate them. They still are going to have those costs if they eliminate that department. So we cannot say that that will be eliminated. So we're not going to, that's not a relevant cost to this decision. So even though it's allocated, it cannot be eliminated because it's costs they already have. So step 4 is to compare all the costs that are, add up all the costs that can be eliminated, and we get $250,000 or $250, sorry, 250,000 for a denture. Whoa. Okay. $250, is that less than what we can, so step 5, let's get step 5 in there, are the costs that we can eliminate lower than the price we're going to pay for them? No. So, no, we should make our own, or he should. I don't want to make dentures. I don't want to do that. No. Okay, no. They should not outsource. Outsource this work. They should make their own. Okay. So that is, it's right in the middle of the slides, but I'm going to go ahead and save that so I can post that online. And we're going to stop this lecture here, and then we will finish the rest of this slideshow in the next session. Thank you. We'll see you next time.